I'm Matt Bishar with NAREITWeek.com here in New York City for REITWeek 2015, NAREIT's Investor Forum. Joining me for this CEO Spotlight is Paul Pittman, Executive Chairman, President, and CEO of Farmland Partners. Paul, thanks so much for joining us.
Thanks for having me.
Your company continues to grow rapidly since its IPO last year, going from 7,300 acres at its IPO to more than 70,000 acres today. How long and how aggressive do you expect that growth to be?
Well, there's around $30 billion of farmland transactions in the United States every year. So there's no theoretical limit on our ability to grow. We would anticipate having the same or even higher total growth during the coming year. We believe that this asset class has very little institutional ownership so far, and by consolidating these assets, we can create a lot of value for our shareholders.
What are the key drivers for the value of farmlands, and how do those fundamentals look in the near term?
At the end of the day, the key driver of farmland values is global food demand, as one would expect. There are other things that push values from time to time. Real estate development generally pushes farmland values because if you're taking land for houses or condominiums or shopping malls, it drives the other land values up. But at the end of the day, it really is just global food demand. That story is decades long, a history at this point, and will continue to go on for decades. So you may get near-term up and downs in farmland values, but the 5, 10, 15-year horizon is more or less a constant upward push on farmland value.
I regularly talk to CEOs in other sectors about the redevelopment costs associated with their business and the need to keep their spaces fresh and new to attract tenants. How does that factor into the farmland business?
This is actually one of the sort of silver linings, if you will, to farmland ownership, because we really don't have very much built real estate. The farm, you don't have to worry about the neighborhood going south on you. You don't have to worry about needing to redo the lobby of your building or to add to a new swimming pool if you're garden apartments or something like that. So for us, we really don't have to continually reinvest in the properties. All of the maintenance of the property is fundamentally done by the farmer. What that usually means is maintaining the fertility of the land. We do occasionally have a small amount of expenses related to irrigation units and wells, but the non-land portion of our portfolio is less than 5% of the total. So really everything's just raw land and there's very little reinvestment. So no leakage, if you will, between AFFO and distributions to pay for these sorts of redevelopment costs.
Paul, thank you so much for joining us.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.